Okay, guys, so look, we'll kick off there. Thanks everybody who's after jumping on the webinar so far today. You're all very welcome on today's webinar, which is centered on achieving financial independence before 60. My own name is David Looney, and I work as a financial advisor with Alpha Wealth. For those of you on the call who might be not too familiar with our services or who might have been on these webinars for the first time, we basically run an impartial financial services company headquartered in Little Island in Cork, and we basically work with individuals and families like yourselves in pretty much all areas of personal finances and financial planning advice. We've 8 advisors in Alpha Wealth who are all QFA and CFP qualified. We've over 6 years of experience between our 8 advisors, and I'm happy to say at this point, in light of a recent acquisition of another brokerage, we now have over 4,000 clients from all around Ireland, as well as over 200 million of assets under management within Alpha Wealth. For those of you who don't know, we've been doing a lot of these kind of online financial webinars since the start of COVID, and this is the first kind of general one I've done after the summer break myself. So apologies if I'm a bit rusty or if we had a couple of technical issues at the start. So today's webinar is going to be very much centered around achieving this concept of financial independence, which is kind of like retirement, but rather than, you giving up work or, being forced to give up work, it's really about having the, I suppose, financial options or the financial freedom to have the resources behind you to maybe take life a little easier and give up work comfortably without having to be in a situation where you're forced to work to maybe stay pension age. Financial independence here is defined as having sufficient personal wealth to live without having to work actively for basic necessities. For financially independent people, their assets generate income that is greater than their expenses. So there's 3 things really we need to become financially independent. Obviously, we're going to need an income stream, which is more than our expenses. We'll need no or limited debt. Obviously, it's not ideal to have things like, mortgage repayments draining off your retirement income. And ideally, we need to have all other future expenditures covered for us. So things like, children's education needs. And in light of all that, the 3 things that I'm going to be addressing on the webinar today to try to get people geared up to this, ultimate goal of financial independence is how you can build up retirement assets to provide a passive income for yourself well before the state pension age. State pension age currently is 66. It pays about 13 grand a year. So one question is 13,000 euro a year enough to live on? The answer for most people there is going to be no. But then as well, it's, do you really want to put yourself into a situation where you are forced to work till 66 or probably even 68 or 70, because it's likely that the state pension age is going to be pushed out. And we'll be spending a little bit of time talking about, how you can become debt free or mortgage free before retirement. And as I said, then maybe planning for other large expenses such as children education costs. We are happy to open it up to a bit of a Q&A session at the end. Some of my colleagues are on the webinar today as well. Ruth Murray, our marketing manager, Clean O'Donoghue, our business development manager, and Nick Charalambis, our managing director, and they'll all be monitoring the Q&A box as well. So if anybody has questions, look, feel free to pop them into the chat box or the Q&A box, and the lads will do their best to get to them throughout the webinar or at the end. So firstly, I just want to focus on building up retirement assets. So for most of us on the call today, our income in retirement is going to come through a pension scheme or pension schemes, unless, of course, we win the lotto or, start a business that becomes wildly successful. Let's call a spade a spade. Our pension is going to be our main source of income in retirement, which is why we need to put so much focus on it. I still think in Ireland, a lot of people, severely underutilized pensions. They are a very complex area, I'll be the first to admit, and that's probably why people don't focus on them as much as they should, and they're probably missing out on a lot of opportunities there. But the reason I talk about pensions as being so important is, firstly, you're essentially getting free money from 2 sources. If you're in a matching company pension scheme, you're getting free money into your pension from your employer through a matching contribution, and then you're also getting free money from the taxman in terms of a 20% or 40% tax saving on anything that's going into the pension. In addition to that, you're getting tax-free growth. Anything you do outside the realms of a pension, you're going to be saving from after-tax income, and then you're going to be paying tax on the growth. So a pension is without a doubt the most efficient way to accumulate a large pot of money over time. So if you think about that, if you have somebody here who's on a 70,000 euro a year salary, and they're paying 5% of their salary into the pension with their company matching at 5%. That's 7,000 euro a year hitting their pension account. But what it's actually costing them in net terms is 2,100 euro. So if you think about that, that's a 340% return before the money's even invested. Now, revenue and the pensions authority give us quite generous scope on how much we can fund into a pension. So people who are under 30 can put 15% of their earnings into a pension each year and get tax relief up to that level, and that gradually rises to 40%. For those who are 60 and over. And the advice we generally give to people is, try to get to as close to that age-related limit as is possible, without, locking yourself inside the door and not going outside. When I talk about early retirement, a lot of people get quite confused because they have this misconception that you need to be paying into a pension until 65 or 68, and that's probably another reason why people are a bit reluctant to pay more money into their pensions. But that's nonsense. I would forget about that. The majority of pensions can actually be accessed from age 50 onwards. Even if you're in a company pension that has a normal retirement age set of 65, if you leave your company, you can transfer your pension to something called a personal retirement bond, which actually allows you to access your pensions from age 50 onwards. And even without doing that, a lot of company schemes will allow you to get early retirement from them. But even if they don't, as I said, you can access it earlier through transferring to a personal retirement bond. If anybody on the call today has pensions that are linked to old employments that they've now moved on to, should I say, they also have the opportunity to move those old pensions into this personal retirement bond to set themselves up for an early retirement. The benefit of doing that as well is you can generally get a lot more choice and possibly better fund performance than your company scheme will allow, because it's going to be restricted to a limited range of funds from only one provider. Whereas if you move out to a personal retirement bond, you can choose any provider or any fund in the market you want to make sure that you're getting the best. A lot of people think it's best as well to amalgamate your pensions, but I would just stress to not do that without getting proper advice, because it can be quite advantageous to have separate pension pots to facilitate a kind of earlier phased retirement. If you move all your pensions into your current company pension scheme, all your money is now locked up until a point where you leave your company or retire from your current company. So by having them in separate pots, you can access them without having to do that. And Alpha Wealth, of course, can review your old schemes and your current schemes to give you, I suppose, independent advice around that. I think there's a lot of confusion as well around, I suppose, the pension options at retirement. So I just wanted to spend a little bit of time talking about that. I know a lot of people, they probably think that, they're just paying money into a black hole over, 10, 20, 30 years. And then at retirement, they'll either get something or they won't. But how a pension works at retirement is generally you'll get to take part of your overall pot as a tax-free lump sum. It's usually 25% of the fund. The first 200,000 of that 25% is tax-free, and the next 300,000 is taxed at 20%. So really, really, generous tax-free lump sums that can come from your pension fund at retirement. There are some other calculations around the tax-free lump sum, but for most people, it's generally about 25% of the fund. The balance of the fund, then, let's say the 75%, you generally have two options. The first option, probably the most popular option for many people nowadays, is to move it into something called an approved retirement fund, an ARF or an ARF. And simply put, it's just leaving the pension fund sit in a pension pot, and you decide how much of it you want to take out as regular income. It can be advantageous as well from the perspective of capital retention, because if you die, the full ARF pot is inherited by your estate. I know a lot of people are concerned that if they die, their pension dies with them. That's not the case with an ARF. It does go to your dependents. The other option, which is kind of the older way that people took their pensions, is to purchase something called an annuity, which is basically when you give up your retirement pot in exchange for guaranteed income for life. Now, the big issue with annuity rates is that they've really been kind of slashed in the last, I suppose, 10 to 20 years. They have improved a bit in the last 12 months, given that interest rates have gone up. But it's really a case of, just building up your pension pot as much as possible and, having a more in-depth discussion with a qualified professional before retirement in terms of which option is best for you. It is possible to do a bit of a blend of both, and it is possible to go with an ARF option first and then move that into an annuity, I suppose, over time. You can't go the opposite way, of course. If you purchase an annuity, you're stuck with it. just to put a bit more meaning behind, I suppose, what this pension roadmap might look like for somebody, I'm actually going to use myself as an example here, and I'm just going to take through, I suppose, the numbers behind my pension and how things look from age 31, which I'm currently at, right up to retirement, and also in retirement in terms of what regular income my pension could potentially deliver for me. So this is quite busy, but I'm just going to take you through the main points. Okay, so I'm 31 now. I set my retirement age to be 58, and I've just over 40,000 euro in my pension pot at the moment. What's been paid in there on a regular monthly basis is 800 euro gross from me, 274 a month from Alpha Wealth. So there's 1,074 a month going into my pension pot. But remember, I'm getting 40% relief on what's going in from my side. So it's only actually costing me 480 euro per month to get over 1,000 euro a month into my pension. So a phenomenal return on investment, even before the money is invested. I'm assuming that those contributions are going to increase by an average of 2% per year, because naturally, salaries and incomes will rise over time and your contribution should naturally rise with that. It would be, I suppose, unrealistic that your contributions would stay level for the next 20, 25 years. And then I'm assuming a fund growth rate of 6% per year. I'll show you a bit later exactly where maybe I'm getting that from. I'd like to think it's very, very doable, if not on the modest side. And I'll show you a bit more on that in a while, as I said. But with all those factors working, I'm projected to accumulate a pension pot of about 1.128 million by age 58. Now, as we already said, the max you can take from a pension pot tax-free is 200,000. So the good news is I'm after hitting that. And that with the remaining value of my pension pot, I can either purchase an annuity. I'm assuming annuity rates in the future are going to be about 5% here, which would give me income of about 46,000 euro a year. Now, these figures do, of course, need to be discounted to allow for inflation. So you'll notice there's I suppose, a separate column here which discounts these figures back into what they would feel like today. Or alternatively, the more popular option with most people is to take their tax-free lump sum and transfer the remaining balance into this approved retirement fund that I referred to earlier. So that's a figure of 928,000 thereabouts. So what I've done here is basically just calculate what level of ongoing income this pot could deliver for me in my retirement years by using an ARF calculator. And of course, we can do any of these calculations with any clients that want to work with us, whether it's a pension illustration to show you what your contributions and your fund value are getting you towards that retirement, or even what your pension is due to pay you in retirement. So basically, as I said, my retirement age is set at 58. I'm popping in the ARF value that I'm investing in the ARF. I'm assuming an average growth rate of 3% per year, because remember, I'm going to be investing much more conservatively at my retirement age. A 1% annual management charge on the ARF, so you could say a 2% net growth rate. And I'm going to give myself income of about 2.5 grand a month, increasing at 2%. And basically what this does is it tells me how many years I can get this income before I run out of money. So as you can see here, it's bringing me about 31 years. So it's getting me almost to age 90, giving me 2.5 grand a month, increasing by 2% per year, which is a pretty decent place to be in. And it's something a lot of people on the call should be able to achieve, if they are playing their cards right, and of course getting the correct advice around that. Now, some people might be concerned about what happens if they live beyond 90, or what happens if they need a lot more than 2.5 grand a month. And it is very possible to get a lot more out of your ARF, because it's worth noting that, I suppose, firstly, you'll be able to draw down additional income from your pension lump sum. There's 200,000 that we haven't accounted for here. Also, the state pension will pay a further 13 grand a year. So that's an extra 1,000 euro a month on top of that. So what you can do is maybe increase how much you're taking from your ARF between ages, maybe say 58 to 66, and then reduce how much you're taking from it after that in lieu of getting the state pension. So it's quite flexible in terms of how much you take from your ARF. All of this, by the way, would be taxed at only 20%, because it's currently underneath the standard rate threshold. So I'm getting 40% relief on my pension on the way in, tax-free growth, big lump sum at retirement, and now getting to take out the balance only minus 20% tax. Another misconception that a lot of people have is thinking that you lose quite a lot of your pension to top rate tax on the way out, which you don't. And as I said here as well, people will generally need a lot less income in their much older years. So you might find that you're drawing more from your ARF, maybe between say 60 and 80, and maybe reducing it thereafter. What I want to talk about now, and it's something that I kind of stress as being really, really important, is making sure that you're getting the right investment options within your pension, because selecting the wrong funds within your pension or ignoring a review can potentially cost you hundreds of thousands of euro in your pension pot over a very long period of time. So as I said here, for instance, if you had 100,000 euro in a pension pot growing at 3% per year for 20 years, that would be a future fund value of about 180k. However, if that same 100,000 was growing at 6% for 20 years, there's a difference of 140,000. So you'd be looking at a fund value of 320,000. So the risk level within your pensions, most pensions will have many different investment funds, and they're usually ranked on a risk scale between 1 and 7. And the risk level that you take with your pension is dependent on one thing and one thing only. It's the time frame that you have ahead of you. So you should be investing in higher risk level, higher risk, higher reward level funds in your earlier years, and then looking to scale that down the closer you come to retirement. You should never change or select your funds based on, speculation or a hunch or what a family member maybe has told you, unless they're a qualified financial professional. It's really important as well to get independent advice around how your funds are performing versus similar funds in the market. Be aware of alternative fund options within your scheme, and also get full transparency on charges, because you can have the best investment performance in the world, but if your pension is I suppose if the charges are quite high in it, you're kind of going nowhere. Just leading on from that, I do want to stress that not all funds are the same, which is why it's so important to get, I suppose, an independent review of your pension and maybe look at alternative options within the choices within your scheme. What I've done here is basically compare various moderate to high risk level funds from different fund managers in Ireland over the last 5 years. So if we go back up to our risk and reward rating, these will be a risk level 5 on a scale of 1 to 7. So we're looking at Zurich, Irish Life, Aviva, Mercer, New Ireland, and Standard Life. And I'm sure most people on the call today will have funds in one of these providers. Zurich are the best performers over the last 5 years in that risk band, with about 50% or about 10% per year over the last 5 years. And Irish Life are the worst at 17%. Everyone else is kind of somewhere in between. The shocking thing is that there's a difference of 32% between the best and the worst fund over the last 5 years alone, despite them being the same risk level. So that's about 6.5% difference per year. So what I would say to people is always ensure you're getting access to the best available. Otherwise, you might as well just be throwing money in the bin. What's really interesting as well is there's 2 Irish life funds here that are quite similar in their makeup. They're a similar risk level, and one of them is after giving 30% is returning 30% in the last 5 years, and the other one is after returning less than 18%. So this is what I was saying earlier about, be aware of alternative fund options in your scheme. You might have a company pension with Irish Life, you might be invested in the multi-asset portfolio 5 fund, and very simple, maybe through an online portal, you can move to another fund of the same risk band, which is performing a lot stronger. And of course, we can give people that, I suppose, independent advice around that if they need it. Moving on from pensions now, what I just want to talk about is, becoming debt-free or mortgage-free before retirement. Naturally, most people will experience a large drop in income at retirement. So ideally, you don't want large loan repayments or mortgage payments draining off that lower retirement income. So what I want to do is look at some ways to clear our mortgage early, ideally before retirement. So there's 3 ways we can do that in my mind. We can either increase our repayments or restructure the term, which is essentially increasing the repayments. Now, most people will just go to this as the default option because they don't know what other options are available, or maybe they're not getting the right advice around it. The second option is maybe to build up some savings and investments, and every couple of years clear a lump sum off the mortgage, or maybe clear it off at retirement. Or the third option, which is usually the most effective, and funnily enough, the one that people often ignore maybe, is to build up your pension as much as possible and use the tax-free lump sum at retirement to clear the remaining value of your mortgage. You might even decide to a combination of all the above. And as I mentioned here, the best course of action for one person, it might not always be the best course of action for another, because it will depend on, your own situation and how everything else is looking. But just to show you how effective using a pension can be to clear your mortgage early, I'm just going to look at a quick example here. Okay, so a 35-year-old with about 350,000 euro of a mortgage with 3% interest and 30 years left to age 65. Their financial objective is to retire at 60. So they want to retire 5 years before their mortgage is due to, I suppose, end naturally. And at that point, they're going to have about 82,000 euro left on their mortgage. So it's not ideal. The repayments are about, nearly 1,500 euro a month. So it doesn't really, align with their goals to become financially independent at 60. They have about 300 euro per month disposable income to allocate to that financial objective of, reaching financial independence, clearing their mortgage early. If they decide to overpay their mortgage by that 300 a month, they're increasing their standard repayments from 1,472 to 1,772. And if you do the maths, at age 60, they're still going to be left with a mortgage balance of 50,000 euro. So they're going to be forced to still work unless they've, other assets built up, aren't they? The repayments are coming from their after-tax income. So they're putting themselves in a situation where they're losing a lot of their income to 40% income tax because they've decided to put them into their mortgage directly as opposed to putting them into their pension. They're essentially saving on the interest, which is about 3%. So you could say they're getting an equivalent 3% net return by, paying down the mortgage. And obviously they're in a situation where, as I said, they might have to keep working. They've no pension built up because they're after over prioritizing paying the mortgage as opposed to building up retirement assets or pension assets. Now, in comparison, let's look at what happens if they put that same 300 euro per month into a pension. Remember that if you put 300 per month into a pension as a top rate taxpayer, you don't get 300 hidden in your pension account, you get 500. So 500 a month to a pension after 40% relief is a net cost of 300 euro. And that's equivalent to a 66% immediate return even before that money is invested, compared to our 3% return over here. Then the individual is saving 2,400 euro a year in top rate income tax. If we're assuming the 6% growth rate that I looked at in my own projections earlier, they're going to build up a fund value of 348,000 at age 60. 25% of that fund value is 87,000 euro, which is more than enough to clear the mortgage. And they're going to be left with a pension fund, a remaining value of 261,000 that they can use to draw down regular income. So for the same 300 euro per month, they can clear their mortgage early and be left with a retirement fund of 261,000. And this is why I say that, using a pension to clear your mortgage early is generally much more efficient than trying to pay down the mortgage itself. I regularly meet people who say, oh, we're not paying into a pension because we're trying to clear our mortgage. And then maybe at 50 or 55, we'll start paying into a pension when we're mortgage free. It makes zero sense because you're missing out on, all those years of tax-free compounding growth and all the, I suppose, the tax savings that you're going to get on those earlier contributions. Now, of course, it might be a case of doing a bit of a balance, putting some to your pension and some to pay down your mortgage. But generally, the pension for a lot of people is the much more efficient option. Moving on, I just want to talk about, planning for other large expenses before retirement. We talked about building up a pension pot. We talked about, clearing your mortgage, but there are other things that we need to plan for in life. It's worth noting, I suppose, that a lot of people nowadays are having kids a little older. So the main challenge many people might face is trying to finance third level education costs when they're either approaching retirement or they're in their retirement years. So ideally, we want to have a separate pot of savings built up for that to avoid draining on our lower retirement assets, as we said. 3 key factors to consider when you are planning for your kids' education costs are to start early and plan ahead. The advice we usually give to every parent is to try to get into the habit of saving the child benefit of 140 euro per month per child from an age where your children are young. Don't underestimate the impact that inflation or rising living and education costs can have on your savings over time as well. I suppose if you're saving for third level education, kids typically start college at 18. You don't want to be putting your savings into a standard bank, credit union or post office account, which is paying maybe, at best 1.5% per year before dirt tax comes off that, because you're going to lose quite a lot of the purchasing power or the real value on your savings over time. So you should always aim to earn positive interest on your savings, which at least matches inflation on your long-term savings particularly. So what return should you be looking to get? I would say at least 3% per year after fees and tax, which you're not going to get respectfully in any bank, credit union or post office in the country. If we look at how much education costs actually are coming out at, there's a lot of kind of surveys around this, and this one is provided by Zurich Life, and it's based on college costs in 2023. So primary school lifetime costs in and around €15,000, secondary school in and around €20,000, and obviously the big one is third level education. So the cost to send one child through 4 years of third level education can range from about 25,800 if they're staying at home, right up to €66,000 if you have to finance student accommodation over that 4 year period. And worryingly, studies show that over 50% of Irish parents are still relying on loans to finance third level education costs. So there is really a case of kind of poor planning. And what I would always say to people is that, if you can't afford to put away, say, 140 a month, 200 a month now, how are you going to afford to be, paying 3, 4, 5, 600 euro a month in loan repayments at the time when your kid is 18? So, take the pressure off and start early. What we usually do in Alpha Wealth when we are dealing with clients in terms of planning for their kids' education is first maybe do a cost of college education projection in terms of what fund they might need to have built up and how much it's going to cost them to build up that fund. So you just see here, this is an example of two clients I was working with recently. They have two children, one is age 2, one is age 4, and they anticipate that they will stay at home whilst they're in college because they're living in Cork. They're going to need a fund in about 15 to 17 years time of about 35 to 36,000 euro per child, and they can achieve that by saving about 304 euro a month. Now, the good news is they're getting 280 euro a month from their child benefit payment, so they just need to pay a little bit extra on top of that to reach their objective, and at least they can park that then and work with everything else in terms of their financial planning, and they're safe in the knowledge that that's going to take care of itself. Now, unfortunately, if they are in a situation where they also need to plan for student accommodation, those costs skyrocket up to about 70,000 euro per child. So they now have to save about 602 euro per month. And look, it's not about, trying to strike the fear of God into people, but it's just trying to, I suppose, get people into the habit of doing what they can while they can, plan early. Obviously, people could say to me, look, my child might get a part-time job, which is very true. Maybe they'll get a grant. So parents mightn't necessarily need to finance every, available cent to get them through that 4 years of education. But it's about putting provisions in place early and doing what you can to take the pressure off in your later years. As I already said earlier, it is really important to look past the bank, credit union and post office for your long-term savings, even though interest rates have started to creep up in the last couple of weeks. A lot of people are probably seeing it in the newspapers. The key thing to bear in mind is none of those interest rates offered in banks, credit union or post offices keep pace with inflation. So you're guaranteed to lose value in real terms. So if you take Mary here, look, she calculates that she'll need about 30,000 euro for her son's third level education in 10 years time. So she sticks it in an non-plus savings bond currently giving 1.5% per year. Even though Mary's getting positive interest of 1.5% net per year, the impact that inflation is going to have on her savings over that 10 years period is, if we're seeing normal inflation rates at about 3% per year, the 30,000 is going to reduce to about 25,850 in real terms. If we're seeing higher rates of inflation, which we're currently seeing at the moment, 4% per year inflation, 30,000 would reduce to about 23,500, or at a higher inflation rate of 5%, whereas this year is kind of up around 6-7%, I believe, the 30,000 would reduce to about 21,000. So you're guaranteed to lose value on your savings in real terms if you were, focusing only on bank, credit union or post office. They're only really a short-term home for your savings. In Alpha Wealth, we always speak to clients about maybe kind of a 4 to 5 year rule, and that simply is any of your savings objectives coming up in, let's say, the next 3 to 4 years, it's absolutely fine sticking to a bank, credit union or post office account. But for anything beyond that kind of 4, particularly 5 year window, you need to be investing your money. So a lot of people on the call are probably wondering where you can get, better interest rates which keep pace with inflation over that 4 to 5 year plus window. we deal with every provider or every main provider, shall I say, in the Irish market. And we believe the best savings plan in the Irish market is offered through Zurich. And we say that as an impartial broker. It's the plan I use for my own savings, and it's the plan I use for all of my clients. It's called the Easy Access Savings Plan, and it basically allows you the ability to save into it on a monthly basis from as little as €100 per month. And it also allows you to invest, lump sums or ad hoc top-ups along the way. It's a really flexible plan in that it gives you the ability to increase, decrease, stop or restart your savings at any stage. And the term is completely open-ended, so you can encash your plan at any stage at no penalties. Now, going back to our kind of, risk and reward level on our pension planning, the same can be said for our savings planning. The longer the time frame you have, the more risk and reward level you take on, and you scale it down the closer it comes to needing that money. Zurich have many different award-winning funds with really good long-term track records, and the risk and reward level can be changed throughout the term. As I said, it's ideal really for that kind of medium to long-term savings goals, such as building up a fund to plan for kids' education costs. And as I suppose a low-cost broker, we do arrange this plan for clients at the lowest fee structure in Ireland, which is giving them 101% allocation to even cover the 1% government levy that's applied to the plans. But of course, we're happy to talk to people in more detail about that, should they need to. The two funds that we would generally maybe look at for clients who are looking at maybe starting this fund for their kids' education, maybe 7, 10, 15, 18 years, is maybe a blend between two of Zurich's most popular moderate risk funds. One is a fund called the Active Asset Allocation Fund, and one is a fund called the Balance Fund. Both of those funds have returned in the region of 33 to 35% over the last 5 years. And mind you, that's in a 5-year period where we've had two disastrous years in markets. We had last year, which was, I suppose, a really challenging year for markets. The global stock market finished the year close to 20% down. And then obviously back in 2020, we had a global pandemic which shut down the worldwide economy. And this is why I say to people that I suppose the risk level you take for your pensions, your savings, your investments, it should only be based on the time frame ahead of you, because everything else is just noise. The only thing that people should be concerned about is what they started at and what the point currently today is. Everything else that occurs between then and now is just noise. So we all know that life is expensive, but there are things we can do to help us get into a better position and maybe try to increase that disposable income that we have for financial planning objectives, whether it's building up a retirement pot, building up funds to clear a mortgage, building up funds for kids' education, or maybe a combination of all the above. It's essential for you to save or invest a minimum of 10% of your earnings. I believe if you can get closer to 20% or more, you're in a fantastic position. How you can do that, or how you can help yourself do that, is firstly by sticking to a budget. Don't underestimate the value of a monthly budget plan. It's something that I encourage every client to do, irrespective of how wealthy or how high their salary is, or how low it is even. We've a really good budget planning calculator on our website, alphawealth.ie. One of my colleagues can pop the link to the budget calculator into the chat box there if anybody wants to visit it. But it's a really handy tool to help you basically, track your income and your expenses and kind of incorporate a savings objective into your month-to-month spending. I suppose how you would really look at that is think of it as you earn X, and you basically map out how to spend 90% of what you earn by allocating 10% to savings first. And I've highlighted savings first because it's really important to get any, of your savings out of your account, ideally on the day you get paid or the day after, and then basically kind of fall into a habit of being able to live on what's left. The second thing you can do is look to reduce your main financial costs and claim tax back and everything that you can. Really important to get into the habit of reviewing all your main financial expenses, and obviously Alpha Wealth as an impartial broker can help. We can help you review things like your mortgage to make sure that you're not paying more interest than you need to, your mortgage protection policy, which I find a lot of people were missold a lot of expensive policies through bank channels when they were taking out their mortgage, and they're really overinsured or paying much more than they need to. Things like house insurance and car insurance, and loan repayments. I regularly meet people who are shelling out a couple of hundred a month in loan repayments when they have all this money sitting on deposit doing nothing for them. And even more important now than ever to look to reduce that whilst interest rates are higher. things like, utility bills and health insurance, realizing that Irish providers do not reward you for being loyal. Really important to make sure that you're getting in the habit of shopping around every year, getting access to online discounts, which gives you maybe, 10% off for purchasing plans online. Things like health insurance, you can avail of certain kids offers whereby you pay for one child and all the rest go free. It's just about, really shopping around and, getting specialist advice in these areas should you need to. And it's about really kind of envisaging where the total savings that could be accumulated through all of these various things we pay for, and trying to imagine where that money could be better redirected to improve our financial future and our financial situation. If anybody is interested in kind of doing, an A to Z kind of full financial planning consultation, we do offer that service to clients where we will look at kind of all aspects of your current financial situation, where you want to get to, and help you essentially get there. We usually charge a once-off consultation fee of €199, but we always like to reward those people who take the time to come onto our financial webinars, and as such, we're happy to offer this consultation service to them at a reduced rate of just €99. So that's a 50% discount. If the review is booked before the end of September, you don't have to schedule the appointment before the end of September. It just has to be booked before the end of September, and just mention that you're on the webinar, or we can even share a discount code if needed. What it basically entails is reviewing your financial situation and plans, setting financial goals and objectives, such as the ones we discussed on the webinar today, providing a cash flow model to predict your future financial situation, mapping out a financial plan to meet your objectives, and also whilst identifying ways to save you money, reduce your tax, and make your money work harder for you. So just to kind of summarize some of the various areas that we can help people in, things like mortgage advice and reducing debt, protection reviews, savings and investments advice, more specialist things like estate succession and tax planning, child savings plans, pensions and retirement planning, which we obviously spent a bit of time talking about today, and tax back investments such as the employment incentive investment scheme, which I haven't discussed today, but it is a tax efficient investment scheme whereby you can claim 40% back on anything that you invest in qualifying Irish companies, typically over a 5-year period, in addition to a return from the companies themselves, which is usually in the region of about 30%. We have some options within that EIS space for this year if anybody is interested in discussing them. So if anybody needs to get in contact with us, my own contact details are there on screen. Look, I'll leave them up for a couple of minutes, but maybe we'll kind of roll into a Q&A session now if there is some questions in the chat.
There are, David. Sorry, I just can't start my video. This is Cleanna here, so thank you very much for those who've sent in some questions. So we'll just kick off the first one, David. It's how to finance retirement between 60 and when the state pension kicks in at 66 or 67.
Yeah, so as I mentioned at the start, the state pension at the moment kicks in at 66. For those of you on the call who might be maybe in the younger cohort, there is a risk that might be pushed to maybe 68, or Jesus, by the time I hit retirement, it could be 70. So it's just really about, doing what you can to accumulate as much of a pension pot as possible. And, a lot of people say to me, how can I draw my pension at 60 when the state pension mightn't kick in until 6 years older? One way is maybe using the tax-free lump sum that you get from your pension to, I suppose, give you additional income for that 6-year period that you're without the state pension. And another way, as we said, is maybe to take more from your ARF fund in that 6-year period that you're without the state pension, and then reduce it once the state pension does kick in. But like all people can do, and the best bit of advice I would give to anyone now is just, do what you can to build up a sufficient pension pot, get the right advice, make sure that you're, invested in the best performing funds that are available to you, and try to fund it as much as possible.
Another person has just come in to say that they have just changed jobs very recently and they have a pension from their previous employer and unsure what to do with it. Should they move it to a PRSA, as you mentioned? And they're just wondering what other alternative options they are available to them. And they also just asked about how can they make an appointment, but I think you covered that. So if you just want to address that. Thanks, David.
Yeah, in relation to the second query, one of the lads, if you could maybe just pop up a link in the chat box on how people can book a review online. It can be done in person or through a Zoom or Teams call. And we're happy to assist you throughout that process. In relation to the first question, if you have a company pension scheme from a company that you've now moved on for, you usually have three options. Well, there is a fourth option. If you've less than 2 years service in the scheme, you'll get to take a refund of your contributions minus only 20% tax. If the pension fund value is quite small, look, you might decide to just do that. Maybe it doesn't really warrant transferring, a very small value over to something else unless you feel it's very, very important, but we can obviously give you advice on that. But the three main options are leave it where it is, move it into the new company scheme, or move it to a personal retirement bond or a PRSA. My preferred option is usually to move it to the personal retirement bond. Why? Because it gives you more control, more choice in terms of where the money is and how it's invested. And kind of breaks the link from the old company. If you move it into your new company scheme, don't like it because now all your funds are locked up in your current company scheme until you leave or retire, and you're kind of restricted in terms of the investment options. And obviously, if you leave it in your old company, it's not ideal. I mean, look, it's a company that you've moved on from. You don't want to be tracking down the trustees at 60 or 65 to see if you can access the pension. You want full transparency, proper management over it.
Thanks, David. The next question is around ARF and tax. So at what rate are withdrawals from the ARF taxed at?
So it is dependent on your overall income in retirement. Okay, so at the moment, a single person can earn up to €18,000 a year, generally in their later years, without paying any tax. You can earn up to €40,000 a year at 20%, and anything north of that is at 40% income tax. It's worth noting as well that from 66 onwards, you have reduced rates of USC and no PRSI, so people are usually in a much more favourable tax situation than their previous years. So for instance, if you're in a very fortunate position where you're taking 40 grand a year out of your ARF and you're getting state pension of 13 grand a year on top of that, the answer is that you'll pay 20% tax on your income up to 40%, and you'll pay 20% tax on your income up to 40,000 and 40% income tax on the extra 13 grand of the state pension. So the difference between 40 and 53. It's a very good complaint to have, to be honest. I mean, look, there's nothing wrong with paying tax. If you're paying tax, you're making money or receiving money. So it's not something that would, I suppose, turn me off building up a pension pot to the extent that I might be paying some top rate tax on the drawings from it. It's a good position to have. It's kind of like not taking a promotion in your company because you've more income and you're going to be taxed more on it.
Thanks, David. So this question is just, can you tell me in what stocks does Zurich Bonds invest in? And also, can you please tell me what are the options where I can get a minimum of 12% growth with no or less tax?
So to answer your first question, all investment providers or pension providers will have a range of different funds, and they're all kind of categorized on that risk and rewards scale. So usually the more you go up the risk scale, you'll have funds which have more exposure to global equities and less exposure to lower risk assets like cash and bonds. And as you go down the risk scale, you'll have less exposure to things like equities and alternatives and property, and more exposure to lower risk assets like cash and bonds. In terms of what companies Zurich invest in, Zurich would invest, their funds would be extremely well diversified. So they would invest in hundreds of the world's biggest and most profitable companies. Companies like Apple's, Google's, Facebook's, Johnson & Johnson's, you name it. There's hundreds and hundreds of the world's biggest and most profitable companies. So really, really diversified funds. What was the second part of that question again?
So can you please tell me what are the options where I can get a minimum of 12% growth with no or less tax?
Make a pension contribution, €100 into your pension, 40% relief, only costs you €60 to get 100 into the pension. That's a 66% guaranteed immediate return on top of any growth you get from the pension. Outside of that, if you're asking where you can get a 12% return for personal monies after tax, my advice is that it involves too much risk. It's more of a gamble. Like the stock market traditionally has given returns of about 10% per year. So if you're trying to get an after-tax return of about 12%, you'd need to be getting a gross return of about 20% plus, which is more akin to gambling than it is to investing, if I'm being honest with you.
So somebody has asked, they've joined the session a little late, and will there be a recording available to watch later? I suppose just to answer that, there will be. It'll be available on our YouTube channel. at the latest tomorrow, and everyone that has attended will receive a link to the recording. Another question, David, you get 25% tax-free lump sum from a pension. If you took the other 75% as a lump sum, what tax will that be at?
Yeah, so the answer is that depending on the size of the pension pot, there is something first called a trivial pension rule, which means that if the fund value is quite small after taking your lump sum, you can take it all out at only minus 10% tax. It's usually a fund value of less than 30,000. But if it's any decent level of a fund and you want to take it all in year one, the answer is that you're going to lose quite a lot of it to top rate income tax. It makes zero sense. Like if you retire at 60 and most people are living till 85, 90, whatever, why would you take all your pension pot in year one and lose a significant amount of it to tax? It makes much more sense keeping it within the ARF. It actually continues to grow tax-free in the ARF, by the way. So, any investment growth that you achieve in an ARF is tax-free, and just take out what you need on an annual basis, and you can kind of manipulate how much you take out to avoid paying too much tax at the top rate. So, as I said, if you earn over 40,000 euro a year at the moment, you pay tax at 40%. So you can basically decide to take out less than 40 grand a year out of the ARF to avoid pushing yourself into the 40% tax bracket, whereas if you take it all, you're going to be losing anything north of 40,000 euro to 52% tax. Wouldn't make sense really on your
This is a
earnings.
very popular topic, obviously, David, because the questions are flying in. Are you happy to keep on taking questions?
Yeah, go for it.
Okay, good. So would you suggest investing in real estate for long term?
As part of a diversified portfolio would be my answer. If you came to me and said, David, should I buy an investment property or put money into a pension? My answer would be to put it into a pension. Why? Because if we look at it under kind of various headings, accessibility, you need to accumulate quite a large pot of money to buy a property. You need to save it from after tax income. You might need to take on a mortgage at very high interest rates at the moment, whereas you can put 50, 100 quid a month into a pension. Diversification, most pension funds are, as I said earlier, exposed to hundreds of different assets all over the world. You buy a property, you're exposed to one residential property in one location that's been rented out to one person. Tax efficiency, any growth that's achieved in a pension is tax-free. You get tax relief on the way in, tax relief on the way up, tax relief on the way up. If you have an investment property, any of the rental income, if you're a top rate taxpayer already, you're going to lose more than half of it. And then if you sell the investment property, you're going to pay 33% capital gains tax. Now, if you can get yourself to a position where you have a decent pension pot, you have other assets, you can achieve a diversified portfolio, and you then want to go away and buy an investment property, go for it. But I wouldn't look at it as one or the other.
How easy is it to move a pension to a different country? Let's say somebody's living here, they have a pension, and they move to the UK or else somewhere in the EU. How easy is it to move it with you when you move?
So the key thing is what country are you moving to? So Ireland will have agreements with certain countries, mainly countries in the EU and the UK, that pensions can be moved between them. It's a bit of a headache doing it, but it is possible. But even if you can't do it or you don't want to do it, it doesn't really negatively affect you in any way. Like, for example, we have a lot of Irish people that go retire in Portugal or Spain, where maybe tax rates are a bit lower, and they'll just get their Irish pension mandated to them, irrespective of where in the world they are. So you can have a pension in a different country and just draw on it, even if you're resident somewhere else in retirement.
And can I invest one time with a lump sum in a Zurich bond? And if yes, what is the minimum amount? Is there any lock-in period for these, or can I redeem at any time? And is there an exit load for these funds also?
So if it's the Zurich Easy Access Savings Plan that I mentioned earlier, if you want to invest just a once-off lump sum and no regular contribution, the minimum is 5,000 euro, and there is no, I suppose, penalties on accessing the money. You can, invest 5,000 euro today and pull it out next week if you want to. I wouldn't advise you to do that, obviously, but you can do so. What was the other part of the question, Cliona? Is it
So is there any lock-in period? And I think you've answered that.
Yeah,
is there a minimum amount, which is you said is
5,000,
the 5,000, and can they redeem it at any time? And is there any exit penalties?
Yeah, no, there's no exit penalties on the Zurich Easy Access Savings Plan. Zurich also have a regular contribution savings plan, which can be started from as little as €100 a month. And if you have that set up, you can actually put any amount of a lump sum into your regular saver as a top up. So if I set up a monthly contribution at €100 per month and I have €1,000 sitting in my credit union that I don't need, I can put that in. It doesn't need to be the minimum of the 5,000. Where if it's only a lump sum with no regular contribution plan, the minimum is €5,000. On both plans, there's no lock-in periods or exit penalties or anything like that.
And in relation to the state pension, the 13,000 that you mentioned, is this taxed or is that the net amount?
Again, it's going to be dependent on your overall income at that point in time. If you have no pensions built up other than the state pension, you're only going to be coming out with 13 grand a year. So you're going to be paying no tax on that. If you have other pensions and it pushes you up below 18,000, again, you're going to pay no tax. If your overall income is pushing you over under 40,000, you'll pay tax at 20%. And if your overall income is pushing you over 40,000, you're going to pay some tax at 40%, only on the balance. So you'll pay 20% up to 40% and 40% over 40,000.
For somebody wanting to identify what their decent pot size is for a pension, how do they do that?
Um, it's different for everyone, okay? But the advice I usually give to people is that if you can accumulate a pension pot at your desired retirement age of kind of somewhere between, I suppose, anywhere over 500,000 in today's terms, you're usually in a good place. So if I go back up to my own pension projection, and this is why it's so important to invest money, okay? Because I'm looking at a pension pot of over 1.1 million here, but when we discount it back to allow for inflation, it knocks a considerable amount off the value, so you always need to kind of put your pension into today's terms. So to answer your question, if you're getting these pension projections done by either Alpha Wealth or somebody else, and your future pension pot is somewhere maybe between 450 and 500,000 in today's terms, depending on your situation, then you're usually in a pretty good place. Now it's different for everyone because look, maybe you have an investment property, maybe you've other assets that might help your retirement as well. But if it's just the pension, yeah, maybe kind of 400,000 or 500,000 in today's terms will be a decent enough pension pot. Now, obviously, if you're happy and in a situation where you are going to be working till state pension age, it won't need to be that much because you'll be guaranteed 13 grand a year in addition to your own pension income.
I think that's nearly it. Oh no, one more question for you. For an annual pension of 35,000, how much of a fund would I need?
Again, it'll be dependent on the individual. Like what I would suggest is to maybe book a financial planning consultation or a retirement planning consultation with Alpha Wealth. And what we can do is, like I've done for myself here, we can project what age you ideally want to retire at, what you're on track to reach, but more so, like if we put in this €36,000 a year here, how long is it going to last for you? Because you might only have a fund value that gives income of 36 grand a year for 5 years, and then you run out of money, which isn't ideal. If you're looking to, like, obviously the person who's going to work till 70 will need a lot less in their fund than the person who wants to retire at 58.
Brilliant. Well, we've had really good engagement with the questions today. So thanks very much to everybody on the call. And thanks to you, David. I'll hand it over to you there to wrap it up.
Yeah, no problem. Thanks for that, Clean. Look, and thanks to everybody who put a question in, and of course anyone who took the time to jump onto the webinar. Look, really appreciate your time. We can circulate the recording and kind of information on the special offer and the consultations with people. So look, enjoy the rest of your day, and hope to speak to you again soon. Thanks.